On July 22nd, Google reported its results for the last 3 months. Revenue beat expectations, profits beat expectations. And the cloud business, the part of Google that rents out computing power to other companies, made roughly twice as much profit on every dollar as it did a year ago. By every measure investors normally care about, this was an excellent quarter, and the stock fell 5%. I want you to sit with how strange that is for a second. A company does better than expected at almost everything it does, and the market punishes it. That doesn't happen by accident. Something in that report frightened people badly enough to override all the good news. Let's find out what went wrong in this video, and if you're not subscribed to my channel already, go ahead and subscribe for more long-term investing content. So Google told investors that this year it now expects to spend around 200 billion US dollars building data centers and buying chips, roughly double what it spent last year. There's a piece of jargon for this. You'll see it everywhere at the moment. The word is CapEx, capital expenditure. All it means is money being spent on things you'll own for years. Not salaries, not marketing, buildings, machines, concrete, and silicon. And two things about that number I just mentioned made it worse. The first is that it went up. 3 months ago, Google said the number would be somewhere around 185 billion. Wall Street had penciled it something similar. Then Google came back and said actually more, and that the next year it will be higher again. So this isn't a one-off. Google is telling the market, we are going to keep doing this, and we don't know where the ceiling is yet. And that's a sentence that knocked 5% off the biggest company in the world. Now, I think the market is wrong about this, but before I make that case, I want to make the other one properly. Because the fear here isn't stupid, it's actually pretty reasonable. There are 3 real worries, and then there's a ghost. The first worry is that there's less money left over. When a company spends money building things, that money isn't profit, it's literally gone into the ground. Investors like companies that generate cash and hand some of it back in buybacks, dividends, that sort of thing. Google is now taking a very large slice of what it earns and is pouring it into concrete instead. In the last 3 months alone, that slice was $45 billion, double what it was a year ago. So that cash that used to flow to shareholders is now flowing to Nvidia and to construction companies. That's a genuine change, and most people, investors particularly, are right to notice it. The second worry is that expensive things wear out. This one's less obvious, but it matters more. Think about a delivery company buying a fleet of vans. They don't count the whole cost the day they buy them. They spread it out. A bit of the cost comes off the profits every year for as long as the vans are expected to last. That's the accounting version of the vans wearing out. Data centers and AI chips work pretty much the same way. Google spends $200 billion now, but a chunk of that comes off its profits every year for the next several years. And chips age faster than vans. What's cutting edge today is second rate in 3 years. So the bear says, you're not just spending this year's cash, you're signing up for a drag on your profits for years to come on equipment that might be obsolete before it's paid for itself. The third worry is no one has proven that it pays. AI is real, the usage is real, but the profits are still largely a promise. Everyone can point to an activity. Fewer people can point to a line on an income statement and say that that's the AI money. And there's one more thing I want to be straight about, because a lot of the bullish coverage skips this. In June, Google raised a very large amount of money from investors, around 85 billion US dollars, specifically to fund this build out. So the picture of a company casually paying for all of this out of pocket isn't quite right. They went and got funding. That's a real fact, and it belongs in the bear case. And then there's the ghost. This is not the one driving the actual fear, but it's whether or not people say it loud or not. If we go back to the late 1990s, telecom companies looked at the internet and concluded the world was going to need vastly more capacity than it already had. So they borrowed enormous amounts of large fiber optic cables across countries, across oceans, millions of miles of it. And they were right, the world did need it. They were just about a decade too early. The traffic didn't arrive fast enough. The debt payments arrived on schedule, and a huge amount of cable sat in the ground, unused. The industry had a name for it. They called it dark fiber, and companies that had been worth tens of billions of dollars went bankrupt on the dark fiber. So is Google laying dark fiber? I don't think so, and it comes down to one thing. Those fiber companies had a belief. They looked at the future, decided the world would need the capacity, and started digging. They were right, but a belief doesn't pay a debt payment. And when the traffic arrived 10 years late, the belief was worth nothing. Google has orders. Buried in the same report that everyone read as bad news, more than $500 billion of computing power that customers have already committed to buy and Google hasn't delivered yet. Not a projection, literally a queue. The finance chief said it plainly on the call. They can't build fast enough to serve the demand they already have. That's the difference between building a factory because you think people might want your product and building one because there's a line out the door. And we've seen how that resolves. In 2006, Amazon started renting out compute power. And for years, analysts said Bezos was distracted, burning shareholder money, and he should focus on selling more books. That distraction became AWS. And within a decade, it was throwing off most of Amazon's profit. You see, every big build gets called reckless while it's happening. And the same is true for every big investment. The criticism sounds the same, whether it's a disaster or the investment of a decade. So the criticism tells you nothing. The question that separates them is never how much they're spending, it's whether anyone's waiting to use it. So what do you actually do with this knowledge? The stock is currently around $340. Its high inside the past year was just over $400. So the market is offering you one of the best businesses on earth, about 15% below where it traded not too long ago. And the business is measurably better today than it was then. But I want to be careful with the word cheap here, because it isn't cheap. Alphabet, aka Google, is almost never cheap. And if you're waiting for it to genuinely be cheap, you'll be waiting forever and own nothing. What this is instead is something rarer and more useful. A moment where a great business is being discounted for a reason I think is mistaken. Because notice what the market actually punished here. It didn't punish a broken product or lost customers, or a competitor eating the business. It punished the timing of cash. Money leaves now, profit arrives later. That's the entire complaint. And timing complaints are the one long-term investors are supposed to be able to arbitrage, because most of the market simply cannot hold a position through 2 years of ugly cash flow, even when they believe in the end state. So the split is roughly this. If your horizon is a year, the bears may well be right, and I'd say that plainly. Spending goes up again next year, and the market may punish it again in exactly the same way. You could be easily sitting on this for 4 quarters, and the thesis still be intact with it going down. If your horizon is 5 years or more, you're being handed a discount because a dominant business is investing heavily in its own future, and that historically has been a good trade, even though it may never feel like one at the time. What I'm watching here for is simple enough for you to check. Each quarter, if that queue keeps growing, but cloud revenue doesn't follow it, then something is wrong with the orders. If cloud growth falls off sharply while spending keeps climbing, then the story stops working. And if Google starts funding this mostly with borrowed money, rather than out of what it earns, that's the one thing that could genuinely also change my mind. Because that is precisely how the fibre story ended. The debt payments don't care whether the traffic shows up. But remember, nothing in this video is financial advice. Do your own work and make your own decisions. And if you enjoyed this video, subscribe to my channel, like and comment, and I'll see you in the next one. Thank you for watching.